Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, December 22nd, 2023. As always, we'll start with our executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So number one, the November PCE report resoundingly supported the soft landing scenario via consumption growth accelerating sharply and inflation decelerating sharply. Number two, textbook disinflation, which is when the 3-month annualized rate of change is below the 6-month annualized rate of change, which itself is below the year-over-year rate of change, that persists in headline and super core PCE deflators. And though the core PCE deflator is no longer exhibiting textbook disinflation, the interplay between the low 3-month and 6-month annualized rates of change suggests a reasonably high probability the Fed lands the year-over-year plane at or near 2% in the quarters ahead. And then lastly, number three, offsetting that reasonably high probability somewhat are the recent dramatic easing of financial conditions and ongoing positive fiscal impulse, the both of which may contribute to upside inflation surprises in the quarters ahead. We will cross that bridge when we arrive at it in global macro risk matrix and macro weather model terms. For now, however, our two most important quantitative risk management systems continue to support betting on the Goldilocks soft landing scenario. We'll let you know when that changes. Transitioning to my 42 macro dashboard here, we'll start with our daily review of the trading ranges provided by our partners over at Longbow. We're looking for anything that's overbought, oversold here, getting an overbought signal here in Ethereum here. So just be aware of that. We're also let's say that's pretty much it. So not much going on this morning. So we'll leave you with some levels for the stock market. You got upside to about 49.18, 49.19, and downside to about 45.96. So obviously a lot more downside skew in that range, getting towards the boundary of the range there. But again, this is a raging bull market. You should not be shorting into that. That's step one. In terms of our 42 macro community, we'll have a question here that asks what happens when the reverse repo facility is tapped out. So I'll just read the question. Says, regarding your recent analysis and observation that highlighted the U.S. Treasury is favoring bills over bonds in its current issuance mix, and tapping funds accumulated in the reverse repo facility to fund the bill supply, and thereby easing liquidity demands on the overall market, what happens when the reverse repo facility is tapped out and the Treasury has to lean on general market again for its funding? The RRP currently has about 780 billion, and it's falling about $8 to $20 billion a day, which implies sometime in March 2024 may be that crunch point. So very astute analysis in terms of projecting the current trend in the RRP to peter out sometime in March. We'll see if it peters out sometime in March. There's no real foundational basis statistically to suggest that that current trend has to persist at the current pace. But assuming that it does persist at the current pace, we're going to be talking about late Q1 or early Q2 in terms of RRP balance declining. And the reason this RRP balance declining is because it's moving money around the financial system in a way that supports risk taking amongst the buy side to ultimately inflate asset market valuations. And so that this is one of the ways in which we track that or derive that conclusion is vis-a-vis our 42 macro net liquidity model, which has become one of the more popular liquidity models out there on Global Wall Street, which is the Fed balance sheet, their total asset side of the balance sheet minus the reverse repo facility and Treasury general account balances. That number continues to trend higher. It inflected into a positive trend higher back in late October when Bitcoin really started to get giddy up. So Bitcoin was Bitcoin called that out in real time. Really, the model was signaling the big push higher we've seen in the cryptocurrency space since then in real time, and that's since been supplemented by our global liquidity proxy, which transitioned to a positive trend sometime in mid-November. And so now that we got both U.S. and global liquidity trending higher, it's no surprise that we continue to see positive trends in asset markets and our global macro risk matrix continue to price in Goldilocks from a top-down market regime standpoint. In terms of the reverse repo facility being tapped out, obviously once it's tapped out, there's an expectation that Treasury Secretary Janet Yellen is going to start extending duration with respect to net financing of the U.S. budget deficits. And the share of bills, a share of coupons relative to bills will increase, and the share of bonds is more than likely to increase as a share of the overall total, which has been fairly low in recent quarters. And so we would expect that outcome, but I think the assumption that that outcome is somehow bearish for asset markets is a little bit too finance twittery and not enough institutional finance for me, because you forget that the market wants bonds when growth and inflation are slowing, as they are currently. the demand for bonds in the global financial system is not static. So the investors may find a very high degree of appetite for issuing those bonds, and so it ultimately means that it's not a tax on the broader financial sector and system as it's sort of bandied about to be in financial markets. There's just this assumption that if the Treasury issues a bond, then stocks have to go down, and I think that's a very flawed assumption of how markets actually work. So there's a lot of moving parts here. There's a lot of sort of frameworks in terms of how to think about liquidity and how to think about financial markets. None of this stuff has been accepted by the hallowed halls of academia, nor would I care if it was. But what we're trying to effectively argue is that you got to pick your framework and stick with it. There's no right answers when it comes to liquidity, because at the end of the day, there's no data set to analyze that says liquidity is X amount of dollars here in this particular geography or here in this, the world we live in. So at the end of the day, we're all creating models to track liquidity. Some are better than others. We think we have two of the best models, in terms of doing that. But the key takeaway is that, we may lose the positive impulse in our 42 macro global net liquidity model. But as long as that positive impulse in the global liquidity model is sustained, you're probably going to still have favorable signals for asset markets, in terms of stocks, bonds, commodities, crypto, et cetera. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, December 22nd, 2023. Best of luck out there today. We'll catch you back here on Tuesday, because Monday is Christmas. So Merry Christmas to everyone. Happy Hanukkah, happy holidays, happy Kwanzaa, all that good stuff. Everyone have a wonderful time with their families. For those of you who may not be with families, just know God is with you, man. Appreciate y'all. Have to catch you back on Tuesday. Thank you.